Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. Sonu, there's a new Taylor Swift album coming out. I know you're excited.
I know that one.
Were you aware of that? Did you see that? Yeah.
I have to say I was. You know, believe it or not, because I have an 8-year-old daughter now who is totally into Taylor Swift and her boyfriend, who, I forget the guy's name. This is some NFL player.
Okay, so not your daughter's boyfriend. You were talking about Taylor Swift's boyfriend. Taylor Swift's boyfriend. That would be Travis Kelce. He plays in something called the NFL. It's American football. The Chiefs are in the AFC. See, everybody, Sonu's the smartest guy I know, but when it comes to football, we really got to dumb it down for Sonu.
my daughter's going to make me watch football now on Sundays.
Yeah, well, that's good for you.
I learned that she's got a new album. Something, I forget the name.
Who knows? But yeah, we playfully joked at the end of 2022, how in the world can you have a recession when Taylor Swift is coming out the summer of 23, touring all over the place, a roaming Super Bowl, if you will. And literally, I'll never forget it, the Philadelphia Fed in the month of May 2023 said our economy was better because Taylor Swift came to Philadelphia. So anyway, all right, everybody, welcome to episode.
More of that.
Yeah, exactly. Hey, that's what I'm getting at. Maybe we got another Taylor Swift tour coming. Keep this economy going. Episode 149 of Carson's Facts versus Feelings. The Fed has an inflation problem. We're going to talk about why we think that very well could be the case. All right, so let's just dive into it. Now, we got more small talk, I'm sure, but just so everybody knows, we're recording this Monday evening. What is today's date, Sonu? What is that?
The 18th is when we're recording this.
Although hopefully we're done before the 19th. Let's just put it that way. It is very, very late. We're busy on Tuesday. So we're just doing it late. So, I'm just going to take a drink right now on the YouTube channel. Check this out.
Oh, there we go. Cheers to you.
It looks like a beer. It's not a beer. It's what do you call it? Liquid death. I tell you, it's water. It's water. I'm not drinking beer on my podcast. It's great. It's like the cleanest, clearest water. You like sparkling water, by the way. Every once in a while I'll chug a water and I think it's regular water and it's sparkling. And I had a liquid death one time. I spent like $3 for it. So excited. And it was sparkling. I just immediately spit it all out. It was horrible. I'm sure somebody likes sparkling water.
I think it's the Europeans. I think it's the Europeans who like sparkling water. Because when I was out there on the continent,
yes,
I was like, "Oh, do you want water?" And then next thing I know,
that's not water. I said I wanted water.
It's not.
It's not water.
I'm not a fan of all this sparkling, the LaCroix, whatever.
Right.
My kids don't drink soda, but now we've sort of okay, you can't have soda, but you can have sparkling water. Right? They're going to town with that stuff. So
anyway, I don't know if there's inflation in sparkling water, but let's just get to it because again, we're titling this one again. The Fed has an inflation problem. This is something I know listeners shouldn't be surprised to hear. You've been talking about this. Obviously, last week the two big things. We're spending a lot of this week's podcast talking about these two things: CPI, consumer level, and then producer level, wholesale prices. Both those came out. How do you want to start this conversation, Sonu? I know you've got some charts also that David's going to share on YouTube, but where do you want to start with inflation?
I just want to ask the listeners how much vegetables they've been eating.
If they listen to our podcast, probably none. Our podcast, I one time ordered a salad, and Sonu did too, and you guys should have seen it. I've talked about this before. He picked at this salad. He was allergic to it. I go, "What's wrong with you?" He's like, "I don't really like salad." I go, "Why'd you order it?" Anyway, he followed my lead.
There you go.
Anti-vegetable podcast.
Wholesale prices for fresh and dry vegetables up 39% in July.
Wow.
So, I mean, somebody's eating a lot of vegetables or the data is wrong, right?
Yeah.
So, but this gets to PPI was hot. We'll talk about PPI. The producer price index was really hot. I think you had a nice chart showing it's like an 8 standard deviation move, right? How, we're not supposed to see that in not just our lifetimes, in the lifetime of humanity. Right? I think we're not supposed to see something like that. But it did happen. It happens more often than not. Usually when I see data points like this, I'm like, either it gets revised and or it reverses the next month. So I don't worry too much about it. I don't go to town on like, oh my God, look at this, right? Look at the broad swath of data. And to that point, I mean, to start with the inflation data, the consumer price index, CPI, came out last week. PPI came out the day after. It was ironic. I thought CPI was actually more worrying than PPI, even though the market had the opposite reaction.
Interesting. Yeah.
I thought PPI was okay. Right? All things considered, I actually thought PPI was okay because PPI matters mostly for PCE because PCE, the Fed's preferred inflation metrics, personal consumption expenditures index. It takes a bunch of inputs from the PPI index, and that was okay. I mean, it's not soft inflation. Let's be clear. Now, we didn't talk about soft inflation, but it's not as hard as feared, right? And this is why, like, let's start with CPI. CPI came out. I think the whisper number, there's always like what Wall Street expects. And then there's what Wall Street really expects, which is the whisper number.
Yeah.
and I think there was some fear that CPI is going to be really hard. Tariff inflation is going to show up, and then it's going to completely put paid to any hope of a rate cut in September. That didn't happen, right? Headline inflation, headline CPI was up 0.2%. That's 2.4% annualized pace. Last 3 months, it's 2.3%, but then we know gas prices have been going down, so that's helped. Core was up 0.32%.
Right.
Let's be clear, that's hot, right? If you annualize that, that is 3.9%. But Wall Street's all about expectations, and I think the whisper expectation was that it's going to be much harder than that. It wasn't. Good news, markets rallied. Last 3 months, core CPI is running at 2.8% annualized. 12 months is running at 3%. Like I said, there was a fear that the number could be worse, but it didn't. That was good news. It sent rate cut expectations for September to 100%.
Yeah, I'll jump in here. You know, it's funny because a couple of weeks ago we were told no rate cuts, right? And then we had that terrible terrible, it's all relative, but that weak jobs number with the huge revisions, all the big miss, we talked about it last week. And then it's like, oh my God, we need like 50 basis points like 3, 4, 5, 6 times in a row. I'm being facetious, but it was, and now we're like, maybe a 25er. It's right in the middle. Kind of funny how quickly those things change. What's the Ferris Bueller quote? You know, life comes at you fast. If you don't pay attention, you're going to miss it. I paraphrase it, but that's, I feel like, with Fed policy, where we've been. The S&P 500 last Tuesday, on against CPI Tuesday, was up 1.3%. So we had a big rally. But one thing you noted in a daily note that you sent out to our Carson partners, and you maybe wrote it in a blog also, but I know we talked about it on a morning call, was the action in yields that day. Like yields actually went up a tick or two, which honestly, if the market was saying, here come rate cuts, I don't know. I think yields might have gone down a little bit. I know it's never that clean cut, but at the same time, that surprised me. Even the action last week, like we'll talk markets more, but stock market was up 1%, small caps up 3%, but bonds, they were flat to down, I think, last week. I mean, I don't know. If you tell me there's more rate cuts coming, I would have thought bonds would have done better. What in the world happened?
I think with rate cuts, the immediate impact is on short-term rates. If you think about the yield curve, it plots rates across the various tenors, right? Treasury yields.
I'll drink to that, yeah.
So short-term rates are basically what markets expect over the next 1 year, next 2 years. That should more or less reflect current rate cut or rate hike expectations, the current path of monetary policy, right? And those yields did come down, because September suddenly the odds of a rate cut rose from, I think it was 80% before the report came out, to about 100%. So it was a lock, right? Except involved with Wall Street, with this stuff, with markets, none of this stuff is ever a lock. We should know that. 100%, maybe 100% only for 1 day, right? But I think what happened in the long-term yields clearly highlighted there were some problems under the surface, right? And that gets to what we're calling this episode, which is the Fed has a bit of an inflation problem. Look, to be clear, I don't think the inflation problem is anything close to their inflation problem in 2021 and 2022, but still, there is a problem, right? Inflation's it's going the wrong way, simply put. It's not going towards 2%, it's going towards 3%, assuming we're not there already, right? So
is it about 85% right now, ballpark?
I think it's come back to 85% after the PPI report.
Yeah, after the PPI. And I know you and I, again, did a call with our partners on Monday morning. And you said, I mean, we probably see a 25 basis point cut, in about a month. But your percentage is not 85, right? You're more like
60,
65, 60, 70.
Yeah, 60, 70. I mean, I'm kind of hedging my bets here.
And again, the rationale why you say that, maybe you're a little more hawkish than the market is because there's an inflation problem. I mean, is it that simple? That's kind of how you see that?
So. Mm-hmm. And the inflation problem is not coming from tariffs.
Okay, good. Now, I know you have a bunch of charts, too. Any charts you want to show up there or share as we go through this?
Let's start with the tariff, because everyone's first thing is, are tariffs creating inflation?
Yeah.
Right? And you and I have talked about that.
That's a popular one. Yeah.
and core goods prices, if you take out food and energy, if you look at things like furniture, appliances, sporting goods, all cars, for example, prices are rising. David, maybe you can put up that chart. Core goods prices are rising again. So core goods prices rose 0.55% in June.
Okay.
And you can tell this is accurate because I'm using 2 decimal places.
Yes, better be.
0.55%, 0.6% in June, right? And it rose 0.2% in July. So here, the good news is the price increase was much slower in July, obviously.
Right.
But the bad news is it's still rising, right? Because remember, what is the counterfactual? The counterfactual is for the last 25 years, ever since globalization really took off in force, China entering the WTI, all of that, we've seen core goods prices.
I believe you mean WTO. You said the WTI. They entered. Isn't that like the ticker for like crude oil or something? West Texas Intermediate. Guys, it's late. We cannot promise anything we're going to say. That's why it's a 2-man show. It's like no. So it was a WTO. That's WTO. All right. Don't worry. Wait till you hear what I say in about 20 minutes.
So good catch. I'm surprised you caught that. But, but like you said, it takes 2 to tango here.
There you go.
But so look, the counterfactual here is that core goods prices should be going down. That's what it's done for 25 years, except for that brief period in 2021 and 2022. We had all the supply chain issues. And even in 2023, 2024, prices were going down, right? And at that time, shelter inflation was elevated. But now, if you had core goods coming down, shelter inflation coming down, we shouldn't have an inflation problem. But shelter, yes, we are seeing disinflation there, but we are seeing some level of inflation. Prices are going up for core goods. That's because of tariffs. Now, I do think there's some seasonality stuff, funkiness going on. Okay. I won't even dare to speculate on what exactly will happen next month because, it's before school, after school season. There's, all sorts of stuff going on with apparel. So set that aside. There was good news in that the tariff-related inflation looked like it was slowing, right? Prices are still accelerating, but still, it is an inflationary force, right? Yeah. Core goods. Now, I put myself in this camp. You've asked me the question before. Do you think, tariff-related inflation is one-off? And my short answer is yes. Right. It shouldn't be. It's just a one-time increase. Now, how it shows up in CPI, it may show up. Well, first of all, we don't even know where all the tariffs will end up. But even if it does show up, it's not going to show up in 1 month. It'll be over 3 or 6 months or something like that. But still, I think it is. I'm going to use the word transitory. Right? I think it is transitory.
Remember Bostic had the swear jar a couple of years ago, and it was if you used the word transitory, you had to put money in a jar. So yeah,
right. But let's
Atlanta Fed Bostic. Yeah.
Let's call a spade, right? Tariff inflation should be transitory. I mean, it's just a one-time increase. It's like a tax increase. It's done, right? But the problem is, wait a minute. If tariffs are not creating a lot of inflation, why is inflation hanging around 3%? Especially when shelter is going down. Last 2 years, we knew why it was around 3%. Because shelter was hot. Yeah. Now it's not. It's disinflation in the shelter category. The problem is core services accelerating. Maybe, David, you can put this chart up of core services inflation heading the wrong way. If you look at services ex shelter, it rose 0.5% month over month in July. If you annualize that, it's close to 6%. Last 3 months, it's up 3% annualized. Put that in perspective, before the pandemic, 2017, 2019, it was running 2.3%. So we are well above that right now.
Yeah.
Right. And at the beginning of the year, it was going the other way. Now it's going the wrong way. Now, when you look at this data, you're always like, wait a minute, is that for real? Is it one particular category pushing it up? Could it be pet services or portfolio management? Like whatever, right? You get these random data points pushing the overall number up, for whatever reason. So another place to sort of corroborate that is to look at something called the sticky CPI, This is excluding food, energy, shelter. I know.
Is that the Cleveland Fed?
Atlanta Fed.
Oh, it's Atlanta Fed. Okay, yeah, got it. All right.
And I know, everyone watching this is like, dude, you can't just take out food, energy, and shelter. That is literally what all of us mostly pay for with our paychecks and stuff. But
yes,
look,
it is.
Right. But set that aside, right? If to look at underlying inflationary issues, you take sticky CPI. This is inflation for stuff for which prices don't change too much.
Yeah, I've always said like a laundromat. I've always said those don't change very often. It's like a quarter, right? I don't know. Yeah.
Maybe dental prices or something like that. We can talk about that, right? Dentists.
Oh yeah, I was going to bring that up. Yeah.
Right, but July again, it was up 0.55%, 6.2% annualized pace. Last 3 months, it's up 4% annualized. Last 12 months, it's up 2.8%. Get this, Ryan. Before the pandemic, 2017 to 2019, it averaged 1.7%.
Okay.
Last 3 months, it's running at 4%, or slightly above that. So we have a bit of an inflation problem. And I think one thing that underlines this, now this will resonate with you, I think, and me, obviously, because I love looking at this stuff and doing it too. Restaurant prices, seated dining, going out and eating. I'm not talking about McDonald's or Burger King or anything like that. So restaurant price inflation is a nice one to look at to gauge, are there any underlying inflationary problems, right?
There we go. Snacks. The one with snacks. We were joking with our producer, David. Snacks. Yeah. We like snacks around here.
Yeah. I went out for dinner. I had this amazing charcuterie board. So that would probably...
Oh, really? We didn't really talk about it. So what did you have? We'll hit time out for a second. What did you have? Pretty good meal in Chicago on a Monday
just
night?
Down the street. And dude, it was packed.
Yeah.
It was packed. Everyone's calling saying it's a recession. Maybe it's because there's a Cubs game and it was rained out.
Hey, the Bengals are on Monday Night Football. I mean, right now, the Joe Burrow did okay. We got him out there getting hurt. I'll take a victory.
Okay.
So, the Cubs are in town too. You said right now they're playing.
They're playing, and but this place is packed. I don't live far from Wrigley, and this place is packed. It's a Monday night. There's a thunderstorm outside, and the place is packed. There's no recession.
It doesn't sound like it. Yeah.
But it gets to the fact that there's demand for food prices. Or consumers at least keeping up with inflation, if nothing else, right? That's why last 3 months, CPI, Consumer Price Index for full service meals and snacks, running at 4% annualized pace. Last 12 months, it's running at, close to 5%, something like that. Before the pandemic, it was running about 3%. So 3%, yes, it's 3% is higher than 2%, but that level is consistent with the Fed's target, right?
Right.
So this is elevated, I think, partly because of food prices. Wage growth, we know it's not running too hot, because the labor market is, not that strong. But it also tells you that the labor market is not too weak, right? There is still some demand. If the labor market is collapsing, if the labor market is crashing, what would we see? We would see food prices or restaurant prices go down a lot. That's not happening. I think this is a problem for the Fed.
Let me play devil's advocate just for a second then, because we do have hotel, motel prices down 5 months in a row, 6 month annualized down 17%. I know your rental cars also recently were lower. Like we said, rents are cooling, shelter's been easing. I'm with you. I don't think the consumer, there's cracks with the consumer, but by no means major cracks. Well, what's your take on hotel prices? Airlines.
I'll give you another one. Airline. I was going to say
they were. I think they might have popped a little last month, but they've been lower the last 4 to 5 months also. And you've been saying that's maybe a sign of weakening demand. People aren't flying quite as much, or not getting the nicest hotel. Maybe downsizing to a degree on the hotels. What do you think on that front?
I was in Vegas over the weekend. That's where I sort of bookended my 1 week vacation to Utah and national parks, all of that.
You had to get your money back,
There you go. So I think part of what that drop off in hotel demand and even airfares is probably international travel.
Okay.
Right. I am speculating a little bit here, but I'm always speculating. Like, that's my job, right? It is my job to speculate. But, let's call it hopefully an intelligent guess. No, I think it's international travel that's dropped off a lot. I mean, we had United's CEO saying, travel dropped off a lot in May, June, July, but we're seeing that come back a little, right? So there is that. I think May and June were sort of the bottom of the economic data. I think for the April, for the markets, it was probably April. But May and June, you always think of like markets lead the economy.
True.
But I think May and June were sort of the bottom for the economy. And it's not like things are going gangbusters, but nothing's collapsing. We've stopped sliding down. right? And I think international travel, that's pulled down hotel prices, airfare prices. But, restaurant prices, going back to that, is something all of us, most of us in the economy, are part of. It's not dependent on international travel. That being elevated tells me that, demand isn't collapsing. The labor market, yes, it's not too strong, but, we got initial claims data, right?
Oh, yeah.
Layoffs aren't increasing, right? And hiring is weak. I do think hiring is weak, but, the labor market is doing okay. And I think the Fed is in a tough spot, right? I mean, the optics of cutting now is not great, right? Inflation's going the other way. If they cut, what do they say? They're basically telling you, we do care a lot about the labor market, but we are not, I'm going to put this glibly, we don't care about the 2% target anymore.
Yeah.
Implicitly, they're saying.
Well, I think that, I don't know. I'm not so sure 2%. I know that's what they maybe still technically say, but I think it's a little higher. But, one thing. So
see, even you said that. You think it's a little higher, but that's it, right?
So.
Yeah.
I was at the dentist a week ago. No cavities, thank you. And I will say the retainer that I use, it's old. And I always take it. It's like, you guys, they clean it for you. They do the lasering and clean it for you. I was like, do you think I need a new retainer? And they're like, yeah, it's probably time.
You do.
Yeah. So I didn't disagree. Usually I don't trust doctors. Well, I trust them, but I don't. I always assume they're trying to one-up me and trying to get me to spend the money somewhere.
No offense to any doctors watching this.
Exactly. But nonetheless, my retainer's in bad shape. And they're like, well, you can get a new retainer or you can get a mouth guard. And I'm like, what's a mouth guard? They go, well, it's like a retainer, but a little thicker. They go, but it's like double the price. I'm like, oh, okay. That's what you're trying. Which brings me to another issue is medical. This, by the way, Neil Dutta pointed this out. We have a unwritten rule. We have to mention Neil every single week. Neil Dutta at RenMac. Neil noted medical care services up 0.8% month over month, mainly because of a huge 2.6% month over month jump in dental services. I'm not there yet, but I go tomorrow. Well, actually, is it today? What time is it? Anyway, I go, who knows what time it is? I go to the, get my mouth, measured, looked at. But remember, I guess back in the day when you got a retainer, they stick all the stuff in your mouth. You can't breathe, all that. What is that? Like
it's like
clay,
Yeah.
And you can't breathe. And anyway, they said now, and I'll let you know, but I guess I just smile and they just take a picture of it. And it's so simple than what it used to be. So we'll
you should tell them just watch the podcast. I'm smiling most of the time.
Exactly. So, but anyway, I'm probably going to get a mouth guard because they say, well, you kind of gnaw your teeth at night. And I probably do, I guess. But so I'm in the market for that. But what's 2.6%? It's a big jump.
Detrick for no rate cuts, pushing up dental service inflation.
I'm doing your part. I don't know what I'm doing here. I mean, is that just a one-off? 2.6% is a huge jump for dental services. Was there something crazy when you looked in there, or it's just kind of one of those things might get revised, and we probably can move forward to PPI after this. But what about that?
I think if I'm looking at underlying inflation or structural forces for inflation, are they on the harder side or not? First thing I already talked about, restaurant prices, right? The other two things I tend to look at are things like dental services.
Okay.
Because it is a discretionary expense, literally what you just did, all right? You know what? Yeah, I'll take the mouth guard. I know it costs more, but
I haven't done it yet. I'm going to talk about it with it tomorrow, but I'm pretty sure I'm going that way. I don't know. They're going to say, well, you need it. I'm like, oh, yeah, I do need it. But I will say this. I never pay the $16 for fluoride. Fluoride's never included. They go, last week I'm there. They go, do you want fluoride? I said, no. They go, you don't want the fluoride? Like they asked me, like, what is wrong with you? I said, no, I don't want the fluoride. I don't do that $16. I'm not doing that one. So,
I bet our Health and Human Services Secretary probably doesn't take fluoride earlier either.
Yeah, I floss every day. I use my own fluoride. I brush my teeth twice a day, so I do my best there.
There you go. But anyway, so dental services is one after restaurant prices because it is discretionary, and then pet services. Anyway, now as somebody who own a pet, so. You don't. I'm sure you don't think of it as a discretionary expense. I think you have to do what you have to do.
I think my pets own me anymore. I mean, we buy this food called Fresh Pet. Like I've got 2 100-pound dogs. We literally spend over $100 a week on dog food. Like it's the craziest. It's like this. It's like if they call it like what do they say? Like it's like people food. It is. It's like it stays in the fridge. It takes up more room in the fridge, and I cut it up and give it to them. Oh, they're so excited. I'm like, what is wrong with me? I don't know.
So over the last year, pet services are up 6%.
Well. Mine's up more than that.
Dental services are up about close to 5%.
I'll let you know how my retainer goes tomorrow. Yeah, I might be there too. Yeah.
And we already showed the chart for this. Restaurant prices, seated dining, it's up about 4.5%, right? So these are all the things that tells me that, you know what? The Fed is pretty far away from their target.
Yeah.
And it's not going in the right direction, right? I think that's the story here. And then PPI comes out, and this is where everyone suddenly freaks out, right? Like PPI comes in at 0.9%, and I won't even try and annualize that because it's some ridiculously high number, like 10, 11% annualized pace. The market is expecting 0.2%. So much for expectations, right? But so PPI matters for three reasons. One is
let me just jump in for a second. Sorry. And that's a great point because it came in 0.9, expected 0.2. And if you looked at, kind of what was expected based on historical beats and historical how it came in, that's a 8 standard deviation move. And you mentioned that earlier, but I want to dive in just for a second. An 8 standard deviation move, everyone, should happen once every 6.2 billion years.
Billion.
Okay.
Like I said, it should be older than humanity.
Now, we actually had a 10 standard deviation beat about 5 years ago, or 2021, when everything's going nuts with inflation. So we've had, I don't even know how many billions of times that's supposed to happen. Now, again, it's just a reminder, and I think hopefully if you listen to this podcast, you're in this industry, or if you're not, you're just new. Here's a little, I don't know if you know secret's the right way to put it, but just something to know. Those random events that aren't supposed to happen in our lifetime happen all the time when it comes to markets, because the honest truth, markets are not efficient. I mean, they're
markets
pretty
and the economy
efficient
too, right? Economic data.
Because that's true. We're talking about markets. Like I'm kind of blending these two things together. But yeah, this is economic data coming in off the charts, and sometimes stock markets do things that just don't make a lot of sense either. But then again, that's just what happens. So anyway, I jumped in, but let's dig into PPI, the producer level wholesale, which again, that was the one the market freaked out on Thursday, even though you said you thought the CPI had a little more worrisome data when you peel back the onion. What'd you find here?
So PPI matters for three reasons from this report. One is wholesale food prices. We just talked about that food price, vegetable prices going up. I mean, wholesale food prices are up 1.4%. That is 18% annualized. Now, I think this probably reverses next month because vegetable prices, whatever is happening, is going to reverse or be revised, right? So set that aside. The big picture is food prices are going up, but I don't think it's going up like 18% per, annualized base, right? It's something much lower than that.
Okay.
Then the second thing is, what does PPI mean for PCE, right? So the three big inputs that go from PPI to the PCE index, the Fed's preferred inflation metric. Medical services, we already talked about that. Financial services, airfares. Now, airfares we know have been going down, so set that aside. That's a good thing as far as inflation is concerned, because airfare prices are, in disinflation or deflation. Financial services, the stock market's been rallying, which means financial advisors, portfolio managers get paid more just because they take a percentage of AUM, right? Yeah. If the market's worth more, they get paid more. And up until last month, there's a lag here, right? PCE and PPI for financial services was reflecting the fact that we had a near bear market up through April. Yep. That's reversed. And now that's floating into the data, right? So, but all said and done, core PCE is expected to come up between 0.25 to 0.3%. Now to be clear, that's not soft, right? But it's not as hot as people expected it. And like I said, a chunk of it is because of higher stock prices. And, I don't know about everyone else, but I'm not too worried if a bull market is pushing core PC higher. That's okay. But if you look at the 12-month pace, year-over-year pace, it's 2.9%. Like I said, it is going in the wrong direction. So that's two things for PPI. Third thing I think is probably the most important thing here, which is margins. So PPI for something called trade services. It measures margins for wholesalers and retailers, and it doesn't measure output prices. And that's because retailers, wholesalers, they don't change the product being sold, right? What's their value add? Their value add is through services that help them sell more items. Maybe they're putting the fluoride toothpaste next to the checkout counter, chocolates near the checkout counter, things like that. Sales promotions, warehousing. That's their value add. They don't change the item being sold, all right? So PPI for trade services measures margins. That was up 2% in July. Now, in our business, we're not complaining if margins are going up. you and I have talked about this before. Margins going up is not a bad thing as far as stock prices are concerned. Now, PPI measures it for the private companies and all of that. It's not just your Walmarts and Home Depots of the world. But it tells you that companies are able to pass through higher input costs to consumers. And the consumer is not exactly weak, right? That's why they're able to boost margins. And maybe they use tariffs as a bit of an excuse.
Exactly.
And they say, you know what? Yeah, we have to raise prices because it's tariffs. But the next thing you look on their balance sheet, on the income statements, it's suddenly like, oh, margins are also going up, right?
Yeah.
And I think we've seen this through earnings season, frankly, as well.
That's what I was going to say. This week, we've got some big retailers. The Home Depot's in there. I'm pretty sure Walmart's in there, and some others. So we'll have to see. One thing, Tom Lee over Fundstrat pointed this out, and you kind of hinted at it here. Tom noted that 0.17% of the 0.92% that we saw from core PPI, again, 0.17% of that came from portfolio management and investment advice. So again, higher stock prices. So that's kind of like, are higher stock prices really inflationary? Probably not. I mean, we've had lots of years with bull markets that didn't have a lot of inflation. So anyway, so that's just something. Inflation. Yeah, that's just something to be aware of. I don't think I had. It looks like services up 1.1%, goods up 0.7%. Again, that's like the highest since March of 2022, at least on the services side, with 3/4 of the overall increase again coming from higher services. But the reality again is inflation, again, it looks a little on the hot side, and you think, Sonu, it's still a problem. So let's kind of take it. You know what? Before we go to the Fed, I want to talk about this. The chart from Goldman Sachs. David, put that one up. This is a great one. Friends at Goldman put this together because we've talked about it, but I thought it was neat that they actually put it together. They said as of recently, who's paying for the tariffs, right? Who's eating the cost of potentially higher prices? As of the end of June, it was, what was it here? 64% businesses, 14% foreign exporters, and then the remainder, which is 22% consumers. Okay, that sounds about right. According to Goldman's data, by October, that'll be the consumers going to pay 67%, as you can see on the YouTube channel. Foreigners are 25%, which means businesses are only 8%. Now, listen, this is their take. We'll see how this shakes out. I shared this on X and went crazy. It was a popular, I don't know, just unpopular, whatever it was. Got someone's opinion on it. First off, do you think on the left, does that sound about right that, foreign exporters are about 14%, U.S. is paying the rest? Does that sound about right? And then we'll talk about what we see in October.
I think so. I think that's correct. I'm surprised it's even as high as 14%.
Okay.
Because if you look at import price data, if foreign exporters are paying the tariffs, we would see import prices. By the way, import prices don't include tariffs, right?
Okay.
Just the way it's measured. And so if foreigners are paying the tariffs, import prices would be going down. It's gone the opposite direction. Now, if you look good by good, depending on what it is, and depending on the source country, China, Vietnam, India, places like that, it's a little different. So that's how I think Goldman's getting to, 14% of the tariffs are being paid by foreign exporters. So I'll trust them on their work. Most of it, the chunk of it, is being paid by 86% is being paid by Americans, right? And by the way, the federal government is collecting a lot of tariffs because President Trump is really happy about it.
Yeah. He's tweeted about it once or twice.
There's a certain irony about, especially a Republican president being really happy about collecting what is essentially a tax, higher taxes, right? So there is, but anyway, set that aside for now. 86%, according to Goldman's analysis, is being paid on the U.S. side. Out of that 86%, 64 percentage points is being paid by U.S. businesses, right? So the vast majority of it is being taken up on the company side, U.S. company side, tariffs. And I think that's right. And this chart now shows data only until June. Right. What did we just talk about? PPI margins for retailers and wholesalers. That's been going up.
Things are changing.
They're starting to pass through the cost to consumers, right? Which is why Goldman expects by, 4 months from now, right? By
October. Halloween? Is it Halloween? Maybe, I don't know.
Go get your Halloween gear now before the prices come in. I think they're selling Halloween gear. They've started doing that. I'm pretty sure.
Yeah, where was I today? I was one of the stores, and they had I was just like Walgreens. Went to Walgreens, got some stuff, and they had like Halloween gear out. I just kind of smiled, like, oh man, this is earlier and earlier every year. Yeah.
Buy it now. That's all I can say. But anyway, we saw from the PPI data that retailers and wholesalers are starting to push the cost through to consumers, and they're boosting their margins while they're at it. So yeah, I kind of believe that chart.
Yeah.
I believe the fact that, yeah, most of this is going to be pushed down to consumers. Now, how it shows up in the CPI data is a whole other thing, right? It could show up in September, it could show up in November, it could show up in January of next year, because there's so many crazy things with the methodology. I'm not saying the methodology is bad. It is what it is. It's very hard to measure these things. I think the BLS does, good work trying to get to the truth of the matter. But the reality is it's a hard thing to do. So because of these methodological issues, it's not all going to show up in October. Right? It's going to be, over various months and things like that.
So that's an interesting discussion. That's one we have talked about before, and I'm sure we'll talk about in the future. But let's kind of put this inflation discussion to bed by ending it with the Fed, right? The Fed, we talked about interest rates already a little bit. I think it's widely assumed probably get a 25 basis point cut in 4 weeks. As of now, we do have another inflation data. We have a jobs print, and we also have Jackson Hole, which is called, I wrote it down. I think I wrote it down.
Some symposium, something?
Yeah, well, like the official name. Here it is.
So they don't call it Jackson Hole?
No. Well, the official name, they're calling it the Labor Markets in Transition. That's like the title of the whole thing. But I think it's called the Jackson Hole Annual Symposium put on by the Kansas City Fed, which, by the way, I was in Kansas City just recently, and had a great time with Mr. Nick Kurtzman and the team. And then Nick sent me some barbecue just yesterday, and he knows I'm a big fan of Joe's.
Of the Z-Man.
I'm a fan of the Z-Man, Joe's barbecue. It's originally started in a gas station, and that is absolutely where I like to eat, is a gas station. And he mailed it to me, and I put it together. And you throw the meat. It's beef brisket, and it comes in like a sealed package. You just throw it in boiling water for 12 minutes.
Incredible.
I can do that. Some onion rings. You put that in the oven for 14 minutes. Well, I can do that. What else did I have?
This sounds right up your alley.
Yeah, very simple. Some provolone cheese. You put that on top. Toasted the bun. It really wasn't like rocket science to put this together. And I had me a Z-Man. It's just, when I say about the Z-Man, if you know, you know. If you've been to Kansas City, you had a Z-Man. It's wonderful. So thank you, Nick, for that nice gift there.
Nick sent me that last year sometime, and that was to die for.
Yeah, it was
fantastic.
Very good. Anyway, back to so I hear the words Kansas City, and I think of that immediately. But yeah, Kansas City puts on this big party, if you will, in one of the most gorgeous parts of the United States, even the world, Jackson Hole. And anyway, again, it's titled "Labor Markets in Transition." So that right away tells you what they're going to be focused on: labor markets, right? And it's again the thing. Okay, what's the Fed more worried about? Inflation or labor markets? And it's widely assumed that Powell's going to probably do a little bit of a pivot, right, and come off a little more dovish and say, okay, everybody who's been hammering me, you want rate cuts, I'm going to give you something here. What do you expect 10 o'clock Eastern time when he's up there on the podium? Do you think he'll turn a little more dovish? Will he talk more about labor markets weakening, and that's why we should cut versus inflation? How do you see your crystal ball playing out?
Honestly, I don't know.
Sonu, it's a podcast. Make something up. Just make something up, whatever.
I mean, that's what I said. The market's putting pricing a September rate cut at 85%.
Right.
I think I'm closer to 60, 70%, which is my wishy-washy way of saying I don't know.
Yeah.
I think on balance, we're probably going to get a rate cut, but I think he's going to couch that by saying inflation. He's going to acknowledge the fact that core services over the last 2 months, it's running above 4%. Sticky CPI.
He's going to say, I listened to this one podcast recently, and these guys said this. Yeah.
Sticky CPI, we talked about that. That's running 5.5%. June and July, annualized pace, right? Remember, this was the stuff the Fed missed in 2021.
Exactly.
And that they were saying, oh, this is all transitory, right? So I think what did they say? Fool me once, shame on you. Fool me twice, shame on me.
Yes,
I think there's a bit of that.
I was going to say we all think of George W. Bush when he butchered that, and I think we're all petrified of doing.
I think I got that correct.
I think it's close enough. Yeah, you did good. You did good. Yeah.
So yeah, let's put this chart up, David. This is September rate cut pricing, right? It's swung wildly over the last 2-3 months.
Yep.
Going into June, remember June payrolls? Now we talked about like July payrolls coming out 2 weeks ago. Everyone was freaked out. Yep. June payrolls actually pretty good, right? Now, of course, all of that was revised down, but when we got it, June payrolls look pretty good. And then people are like, oh, everything's going fine. maybe we should lower the odds of a rate cut. Rate cut odds fell to like 68%. And then the Fed was pretty hawkish. Powell was pretty hawkish during his press conference. Then the base case for markets was that we're not going to get a rate cut. Right? The odds of a rate cut fell to about 38%. Then we got the bad payrolls report. And the rate
160%. I'm teasing it. You can't go above 100, but
pretty much. We all 160% means one rate cut plus 60% odds of a second rate cut, right? But July payroll data set the odds of a September cut to 80%. After CPI, it went to 100%. It's a lock, right? You would think 100% is a lock, except the next day you get PPI and it goes back down to 85%. Honestly, I think Powell could go either ways at this point.
Yeah, it almost had shades of late 2018, if you were around the markets then. The market wanted a cut. I don't know the exact numbers. I don't remember off the top of my head, but the market wanted a cut. Powell, this is one of his, he started in 2018, so it's December of his first year. And he came off hawkish and didn't give the market what it wanted. Market literally had like a bear market in 3 or 4 days. For those of us that were there, you remember this crash into
December 24th, right?
Yeah, this is into Christmas Eve crash, bottom of the 26th, and off to the races. Because about a week later, early 2019, he changed his tune. In 2019, one of the least volatile, best bull markets we've seen in a long time. But the question comes up then. I think they're probably cut. I think the market's kind of forcing his hand. He'll give him 20. I mean, is there really a difference between 450 and 425? I mean, I don't know. I don't think so. And with the labor market weakening and the title of this whole shindig out there, with the word labor in there, I think you will. But anyway, a year ago, on September 19th, which was Talk Like a Pirate Day, I only remember this because it's also my son's birthday, the Fed did the 50 basis point cut, first cut in a while. But that was a cut virtually at all-time highs. They cut again in November of last year with the market virtually at all-time highs. And we pointed it out then, I'm pointing it out again. The last 20 times the S&P 500 was within 2% of an all-time high, and the Fed cut rates. So the Fed can cut, we'll be clear. They can't cut with stocks all-time highs. Like, well, they really cut with all-time highs? Listen, that's not one of their mandates. Trust me, I know they know what the market's doing. But that's not one of their mandates. They're not supposed to really care about the stock market per se, although I think they all probably do deep down, let's be clear. But still, 20 times they've cut with the market near all-time highs. A year later, higher, as you see on the YouTube channel, 20 times. And the one in September is about to trigger 1 year later. Stocks are up November, so we don't have a big sell-off before then. We're probably going to have 22 out of 22 times when they've cut with stocks all-time higher a year later. Yes, 3 out of 4 times the stock market's higher. You can randomly pick this stuff. But I think this is the old saying, don't fight the Fed. I mean, the Fed's starting to cut a little bit. Market's already strong. That's a bullet point for me to think this bull market's still around. What do you want to add to that, Sonu?
No, I think on balance they do cut. But I think it'll actually be, I've been thinking about the game theory of this. And look, Powell's going to end his term next year anyway.
Yep.
And, I'm not saying he's going to do this, but it's fun to think about. So, I'm going to put this theory out that, look, what's he going to do after this? He's probably going to go on the speaking circuit, write a book.
We're going to have him on this podcast. I mean, you think I'm not kidding. Like, I don't know where he is. Let's have him on our podcast. That'd be great. He'll probably go work for PIMCO. We'll say politely, PIMCO, can he please come on our podcast? And we'll see what happens. Yeah.
There you go. Thank you to our good friends at PIMCO.
Thank you in advance, PIMCO, for that. We appreciate it. Yeah.
There you go.
We had a call with him today. We're asking for people to join. But anyway, yeah.
So if he's looking to maximize, like his future earnings, what do you do now? Maximize the drama of it, right?
I mean, he and Trump should go on Joe Rogan, and they should make a pay-per-view. And anyway,
he could come out and say, you know what? Screw it. We're not cutting at all. Well, maybe he gets fired. Maybe they go to court. And dude, that is going to send his book sales through the roof. Right.
Maybe not the market. I don't know if the market's going to like that, but
No, anyway, I was kidding. I was talking about this with our friend Jeff Vaniger over dinner. He's who I had dinner with from Wisdom Tree, and he was joking about this. So I thought that's an interesting theory. No, I think on balance, probably they cut, but I don't think he's going to sound very dovish. I hate thinking about it's going to be a hawkish cut or dovish.
Oh, that stuff confuses me. Yeah.
But still, I don't think he's going to sound too dovish.
Okay. Yeah.
Right. He may still signal a cut, But I don't think he's going to sound too dovish. Not with inflation doing what it's doing right now.
Well, I think that's our case, right? I think the market's pricing in, like 2.5 cuts, I believe, right about now. And we'd say it's probably more like 2. I mean, we're probably a little bit less than the market, which kind of, I know we've maybe got like 5-6 minutes to go here. Small cap soared 3% last week, again, on hope, I guess, of rate cuts, optimism of rate cuts. You could argue with something that's oversold as small caps, underperforming longer than they have. You could just have these blips of strength at any time. But we're still a little bit underweight small relative to large. And I think the easiest way to put it, Sonu, is we're not buying the Fed's going to cut as much as Fed fund futures. Is that the simplest way to put it? Yeah.
I mean, at the beginning of the year, when things are going in the favor of disinflation and all of that, at that time, we were at 2 cuts.
Right,
when we wrote our 2025 outlook. And I think 2 cuts is probably the base case right now. 3 seems a little bit of a stretch unless the unemployment rate, goes up to 4.5%, 4.6%. I don't know that it will. At least looking at the claims data, initial claims for unemployment benefits, so far that looks okay, right? But at the end of the day, I think there is some puzzlement over why the economy seems a little weak. Rates are high.
Is puzzlement not even a word? Puzzlement?
I don't
even know. This late at night, it's a good word. I don't know.
I'm going to use it.
It's a word tonight. It is. Yeah.
Why are markets doing so well? Right? The S&P 500 is up 10.5%. And maybe you can close out for this. I think it comes down to, earnings growth.
Yeah.
Right? If you break down, I've done this before. I've talked about it in the podcast. You can break down the total return for the S&P 500. It's up 10.5% through last Friday, August 15th. You can break it down into how much is coming from profit growth, forward earnings per share growth, multiple expansion, dividends. Profit growth accounts for 6.1 percentage points out of the 10.5.
You sent this chart to David, right? We'll put this chart up right now.
Put this chart up. Sales growth and margin expansion, right? Multiple expansion accounts for 3.5 percentage points. Dividends just under 1%. So that's how you get to 10.5%. Profit growth or EPS growth, you can break that down into sales growth, which basically is nominal GDP growth. As long as nominal GDP growth is humming along, okay, you should get sales growth, you should get revenue growth. But corporate America also has operating leverage. What does that mean? That means as sales go up, margins expand. We just talked about PPI and prices being pushed towards consumers and things like that. Margin expansion accounted for 1.6 percentage points out of the 10.5%. So that's actually pretty good. Sales growth accounted for 4.6 percentage points. Big picture is that companies are doing pretty well, right? I mean, that's why the market's up. It's really as simple as that.
Yeah, I mean, I had a radio interview, do it every Monday with the Business Briefing, Janet Alvarez on channel 132, 10 o'clock Eastern every Monday. And she kind of said, really, we talk about all this concern and worry and inflation and the Fed and blah, 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 blah. And she's like, why are stocks at all-time highs? I said, because earnings are still solid. I mean, end of the day, our strong earnings can really make up for a lot of sins, I think is probably the best way to put it. We still have a pretty strong eurnings backdrop.
Actually, one last stat, right?
Yeah, let's hear it.
S&P 500 earnings calls back in April and May, out of 500 calls, there were 429 mentions of the word recession.
Okay.
This is April, May, soon after Liberation Day.
Well, that makes sense. Yeah. Okay.
July, August, this earnings season, that's dropped to 67. So companies prepared for the worst. The worst didn't happen, but they got a little more efficient, a little more productive, things like that. And that's why earnings are growing, margins are expanding, and, that's the story.
I mean, we talked, I think it was last week with JC about AI, right? How strong AI has been, and then the incredible earnings growth out of AI. And by the way, last week, episode 148 with JC Peretz, I think it was Talking Charts with JC, huge downloads and huge views and listens. It is the most watched YouTube video we've ever had. We've done 148 of these. And when JC joined us, that's the most we've ever had. So thank you. And
thank you, JC.
It was great. If you haven't listened to it yet, check it out.
And thank you to all the listeners too. So welcome.
Oh yeah. JC's hilarious. And thank you to, like you said, a lot of people listen to this. Subscribe, give us comments, give us likes, give us follows, do whatever you want on YouTube channel. Now we do have comments open. So if you want to help us with the algorithm, just feel free and chime in whatever you want to chime in on the YouTube channel. But it means a lot to Sonu and I to have so many people. And
talk about vegetables, eating vegetables.
Yeah, that brings us to episode 150. We're not going to say who it is. Maybe I'll just say they have been on before. We'll just leave it there. But huge guest, someone we're super excited about. You want to add anything without giving it away?
I'll give it away if I say anything more. So
gotcha.
You said it best. We'll leave it at that.
Yeah, we'll leave it at that. But now we have a really special guest coming up next week, which you're going to love. All right, so now we're at the end. It is. I got up at.
You got to go to bed.
I got up at 5 o'clock Eastern time because my son is playing football and they have to get there at 5:40. So it's now 11:20. It's now 11:20 Eastern time. I have to get up at 5 Eastern time again tomorrow to take him to football. So
you're a better man than I am.
I don't know. I'm a tireder man. I'll tell you that much. I don't think I said anything too stupid on the podcast tonight. When you're tired like this, I'm worried. Yeah, I don't know. Well, hopefully David will save us and bleep it out if we have to. But any final comments, Sonu? Then we better shut it down this week.
No. I think thank you to all the new listeners. So welcome. Hopefully stick around. Subscribe to the podcast. Leave us a review. Give us your feedback. We love the comments. So I'll leave it at that.
No, we'll leave it there. A lot going on. Obviously, we'll focus a lot next week. Actually, no, we're recording it early before the Fed, but we'll talk about the Fed soon enough and Jerome Powell. And listen, you know where to find us, carsongroup.com/research. Obviously, we're all over social media. There's lots of places where I know you're probably going to write a real detailed blog, like on Monday, I think, on what the Fed had to say, right? On
maybe I'm choking up right now. Just
get so excited talking about it.
Coughing. They need to go to bed or something. But no, maybe it'll be 2 blogs. I'll write something on Friday and then Monday again. So as Ryan said, carsongroup.com/research.
Or just follow us on X. We always share it there. But there's lots of stuff out there. So with all that, everybody, it's late for where we're doing this now. It's time for bed. This is, again, episode 149 of Facts versus Feelings. The Fed has an inflation problem. We'll see everybody next week with a very, very special guest. We'll see you then. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.